If you're thinking about investing in a real estate, but don't want to deal with the hassle of proving your income to a bank, this video is for you. Today, we're talking about DSCR loans, one of the easiest ways to get a mortgage as an investor. We'll break it down with simple examples to make it easy to understand, talk about what they are, how they work, and most importantly, if they are right for you. So, what is a DSCR loan? DSCR stands for Debt Service Coverage Ratio, and it's a fancy way of saying, can this property pay for itself? Instead of looking at your personal income, a lender looks at the rental income of the property you're buying. Here's the deal. If the rent covers the mortgage and other costs, lenders feel safe giving you the loan without asking for W-2s, pay stubs, or tax returns. Sounds pretty great, right? Okay, let's break this down. DSCR is calculated using this simple formula. DSCR equals rental income divided by monthly housing expenses. If the ratio is 1.0 or higher, that means the property is covering itself. If it's below 1.0, that means the rent isn't enough to fully cover the mortgage and expenses. Let's say you're getting a property with a $2,000 monthly rent, and your total monthly housing expenses, including mortgage, taxes, and insurance, are $2,000. So take that $2,000 divided by $2,000 equals 1.0. And that's a break-even DSCR. Most lenders will approve this. But let's say your rent is only $1,800 and your housing expenses are $2,000. So take $1,800 divided by $2,000 equals 0.9. Now you have a DSCR under 1.0, which some lenders might reject, or they'll charge you a higher interest rate. Now let's talk about DSCR loan interest rates. These rates are influenced by the borrower's credit score and DSCR ratio. But here's the thing. These interest rates are only about 0.5% to 1% higher than conventional loans. How about down payments? Down payment requirements for DSCR loans usually range between 20 to 30% of the property's purchase price. The amount can vary based on property type, loan-to-value ratio, DSCR value, and market conditions. Most lenders will require property appraisal to determine its market value. As part of the usual appraisal, the appraisal will provide a 1007 rent schedule based on comparable rentals nearby, current rent, or rental history to prove the property's income potential. Now, what happens if your rent is lower than your monthly expenses? A few things could happen. 1. Some lenders may still approve you, but you might have to put more money down. By putting more down payment, the loan amount gets lower. That means less monthly expenses to qualify for the ratio. As an example, for a $400,000 house at 7.25% interest rate, the market rent $2,300 a month, with a 20% down. Take that $2,300 a month divided by the total housing expenses of $2,363 a month equals 0.97. Now you have a DSCR under 1.0, which some lenders might reject or they'll charge you a higher interest rate. But if you put a 25% down instead, that brings us total monthly housing expenses of $2,227. So take $2,300 divided by $2,227 equals 1.03. Now you have a DSCR over 1.0, so most lenders will approve this. What happens if your rent is lower than your monthly expenses? Number 2, lenders might require reserves, meaning extra cash saved up to cover payments in case of shortfalls. All right, let's talk about the pros and cons of DSCR loans. Pros: no W-2s or tax returns needed. Perfect for self-employed investors. Fast approval process. Less paperwork means quicker closings. Unlimited properties. Unlike traditional loans, DSCR lenders don't cap how many mortgages you can have. Cons: higher interest rates. Typically, DSCR rates are about 0.5% to 1% higher than conventional, which is not so bad. Stricter property requirements. Your rent must generate enough income to meet lender requirements. not for primary residences. You can't use DSCR loans to buy the home you live in. So, who should consider a DSCR loan? If you are a real estate investor looking to build your rental portfolio, self-employed person who can't qualify for a traditional mortgage, or if you are someone wanting an easy no-income check loan, then DSCR loan might be perfect for you. DSCR loans are an amazing tool for investors who want a simple way to qualify for rental property loans. But they come with a bit higher rates and stricter property rules, so make sure you run the numbers before jumping in. Do me a small favor, if you found this video helpful, hit that like button, subscribe for more real estate tips. See you in the next video. Bye.